Hello everyone, thank you once again for joining our online learning. In this lesson, we will be looking at group financial statement, what is popularly called a consolidated financial statement. So we are going to look at the basic principles of consolidation, how we identify a subsidiary, how we identify an associate, what is control, when do we have control, and when do we not have control. Now, we also look at the consolidated financial statement preparation from a group perspective, where we have more than one subsidiary. We will look at the statement of profit or loss and OCI, also where we have more than one subsidiary. Then we move on to look at the cash flow, the statement of cash flow for the group. And then lastly, we'll look at how we deal with a foreign subsidiary. So in the event that we have a foreign subsidiary, how do we translate the accounts of the foreign subsidiary before we consolidate it with the rest of the group? So it's a long list of topics to cover under the group financial statement. So let's begin with overview of the standards. The first standard is the IFRS 10 Consolidated Financial Statement. This standard defines control. It sets out how we can identify a subsidiary where there should be control. So the definition of control or the principle embedded in control. Then IFRS 3 business combinations try to define what a business is, and we need to identify clearly that there has been a business purchase. Then it also sets out what we call the acquisition method. What are the principles we look at when we are calculating goodwill at acquisition? Then we look at the IFRS 11 joint arrangement. Joint arrangement talks about where there's mutual agreement between two or more parties, where there should always be consent on decision making. And in most cases, returns are shared equally between the parties. So we'll look at the similarities between the IFRS 11 joint arrangement and that of associate. The IAS 28 investment in associate and joint ventures. So it defines where we have significant influence over an investee and how do we account for the investment in associate using the equity method. Then the last part of it will be the IAS 21, the effect of changes in foreign exchange rate, particularly accounting for foreign operations for subsidiaries. So this is what we'll cover. Now let's look at the details. To start with, we want to look at the types of investment that we can have. Now mainly we can have these three investment types, but there could be more. The first one is on subsidiary and a parent relationship, as you are aware, where we identify a subsidiary as the entity that is being controlled by another entity. The second is the associate under the IAS 28. The third is joint ventures, or what we can say joint operations. We account for it using IAS 28 and also IFRS 11. So these are the three main investment types we'll be looking at as we consolidate the financial statement of two or more entities. To begin with, we have the definition of control and who a subsidiary is under the IFRS 10. Starting with the definition of a subsidiary. So a subsidiary is an entity that is controlled by another entity. And let's say we have entity A and then also entity B. If entity A controls entity B, then entity A is the parent entity and entity A is the investor, Entity B is a subsidiary, and entity B is the investee. So it's important we have this distinction that a parent controls a subsidiary. But what is the key point about control? So the key point about control, on the face of it, we say that the investor controls or owns majority of voting rights. The investor has majority of voting rights. By extension, we can say that the investor owns majority of ordinary shares. The investor owns majority of the ordinary shares. So that is on the face of it, we're looking at control. Now, interestingly, under the IFRS 10, the definition of control goes beyond the absolute ownership. Now, when we say absolute ownership, it means that for there to be a control, which is to say that we have a parent and a subsidiary, there should be ownership of 50% plus. So the parent should own more than 50% plus of the voting shares. And I need you to make these notes as you watch the video. So it's important we understand these details so we can build up. Now, we're saying that on the face of it, control in terms of absolute value, the investor who is a parent should own more than 50% of the voting shares. And the voting shares, we mean the ordinary shares on the face of it. Now, the IFRS 10 definition of control is principle based. Principle based in terms of not in terms of value. It's not quantitative. It is not quantitative, but rather principle based. So it is stressing beyond the point that the parent should have more than 50% plus of voting shares. What then is the control? Now, under the IFRS 10, control is defined as where the investor has all of the following. One, the investor should have the power. So the first point is that the investor should have the power over the investee to direct the relevant activities. And often, if we say relevant activities, we are referring to the financial and operating decisions. One can say policies, but we are referring to the financial and operating decisions. So there should be power over the investee, and then the power means that the investor has power to govern all the relevant activities, both financial and operational. All the activities on the investee, the investor who is the parent has power. And in most cases, that power will be demonstrated by having majority of directors on the board. So the investor will have majority of directors on the board of the investee, and because they have that majority, they will be able to govern. They would be able to, in terms of voting right, they will have majority voting on the board. The next point is that control means that the investor has an exposure to variable return. Now, these variable returns is dividend. And as we know, dividend would be paid based on the performance of the investee, or also based on the dividend policy of the investee. So the subsidiary directors can choose to pay dividend or not pay dividend, and the amount of dividend would vary depending on the performance and also the policy they have adopted for dividend payment. Now, the same control means that the investor has the right to receive those returns. So there is exposure, there is a risk to the variability of the return, and then there is also a right to receive those returns. So because the investor would be directly involved in the management of the subsidiary, by virtue of the involvement, he has a right to receive those variable returns. And the risk comes with it because there could be variability in the dividend. The last point which should be relevant is that the investor has the ability to use his power over the investee. It might not be evident that they are using the power, but they should have the ability to use such power. And again, it comes from they having majority on the board. They having majority voting rights on the board of the investee. Now, the IFRS 10 is telling us that let's understand that control is principle based, and the investor can have less than 50% and will still have control. And in most cases, it is through shareholder agreement, it is through contract with the other shareholders, such that even though the investor has less than 50% of ownership of shares, they will still control if there is an agreement, if there is a mutual agreement with the other shareholders. Now let's build on with this understanding. And like I've said, how do we identify a subsidiary? The parent should have more than 50% of the voting rights, and I mentioned that it is the ordinary shares, equity shares. Now, there could be less than 50% of ownership, but there could still be control, because we're saying that the IFRS 10 position is that control should be principle based. How can this happen? Through shareholder agreements with the other shareholders or investors, such that the entity who is the investor could have majority representation on the board, could have majority voting rights, could control or have the power to govern the financial and operating policies of the investee. So by mutual agreement or contractual agreement, by appointing majority of the board of directors, by casting majority votes, or by having the power to govern financial and operating policies. And then finally, through indirect investment. Now, for indirect investment, we say entity A, entity B. So between entity A and entity B, there is an in-between entity. So I can call it entity C. Now, entity A controls entity C. So once entity A controls entity C, let's say by 80% interest, and entity C controls entity B. For entity C has 100% ownership in B. Now the point is that entity A have no direct investment in B, but because of its investment in entity C, entity A would indirectly controls entity B, and that is what we call the indirect investment. Because of entity A's investment in entity C, and because entity C controls B, entity A indirectly controls B. And we'll be looking at the effective control. We call it effective control. And that requires that there should be consolidation. So we'll look at the details of that when we are looking at the group structure. So we'll build on with a question quickly. The question quote is an extract from a full question. So the part we're going to look at is mainly about the principle of control. So let's look at the requirement. For 6 marks. Court feels that the consensus required above does not constitute a hindrance. Does not constitute a hindrance to the power to control pattern, as it is customary within the industry to require shareholder consensus for decisions of the types listed in the shareholders agreement. Okay. Court also sold 50% of a previously owned subsidiary. So a previously wholly owned, and wholly is 100%. So they have sold 50% of it. Then they will have left 50%. So Court also sold 50% of a previously wholly owned subsidiary pattern to a third party, Manis. Manis is in the same industry as Court. Now, Court has continued to account for the investment in pattern as a subsidiary in its consolidated financial statements. So you'll be thinking that 50% constitute control. Let's see the details of the question. The main reason for this accounting treatment was the agreement that had been made with Manis, under which Court would exercise general control. Over patterns, operating and financial policies. This just as one aspect of control. Court has appointed 3 out of 4 directors to the board. Look at it, it has the power. Another principle of control. The agreement also stated that certain decisions require consensus by the 2 shareholders. So 1, 2 indication of control. All these are indication of control. Let's take note of that. Now, under the shareholder agreement, consensus is required with respect to significant changes to the company's activities. Now, when we say consensus, it means that the 2 parties have to agree. So it means that there is no majority decision making. The 2 parties have to agree. So there should be a mutual agreement concerning significant changes in the company's activities, plans or budget that deviate from the business plan, accounting policies, acquisition of assets above a certain value, employment or dismissal of senior employees, distribution of dividends, or establishment of loan facilities. Now, on the face of this, you would see that these are restrictions. Restrictions to power over monies. Because if significant changes to the company's activity require consensus, deviating from business plan require consensus, that in itself is restricting the power that court might have over the investee monies. So you want to look at, because it's a discussion, the directors want to know whether they are right to treat monies as a subsidiary. So you have to lay out the consolidation principle. What is control? Control, three things have to be in place. The investor should have power over the investee to direct the relevant activities which are financial and operational. By that power to govern, the investor would have majority representation on the board. The investor is having exposure or a right to receive variable returns, and he has the ability to affect those returns. And then we're saying that due to his involvement, he has ability to what? Exercise the power over the investee. So you want to look at this. Now earlier there are indications that there is control, because there is an agreement where court will have or will exercise general control over the financial and operating policies, will have majority on the board, that is voting right. But subsequent to that, you would see that there is an agreement which indicates that there should be consensus. You would want to think that these consensus on these decisions is likely to what? Limit the power that court will have monies. So yes, there is 50%, and once there is 50%, that does not in itself indicate control. So we cannot use the absolute values to what? Answer to say there is what? A subsidiary or there is control. But we can have less than 50%, and there should be what? Evidence that there is control before we can consolidate. So you have to lay the principle, pick evidence from the case to support your principle, and then finally you make a conclusion. So let's go through the answer on the next slide quickly. Here we say that in accordance with IFRS 10, an investor considers all relevant facts and circumstances when assessing whether it controls an investee. Yes. An investor controls an investee when it is exposed or has a right to variable returns from its involvement with the investee, and has the ability to affect those returns through its power over the investee. And an investor controls an investee if all of the following are relevant or are in place as per the IFRS 10. 1. There is power over the investee, that is, has the power to affect all the relevant activities. It is exposed to variable returns, or it has right to receive variable returns, and it has the ability to use its power over the investee. Now you want to link that to evidence from the case. Now power arises from right which may be obvious through voting right, or may be complex because of what? Contractual arrangements. An investor holds only protective rights. An investor that holds only protective rights cannot have power over an investee, and so cannot control an investee. And in this case, there are restrictions that indicate that there is a protective right. Now, a parent must also have the ability to use its power over the investee to affect its returns from the involvement. Now, in the case of court, so the shareholder agreement shows that court has influence over the company, but the restrictions in the agreement with regard to the decisions to be made in the ordinary course of business, such as the consensus between the shareholders required for acquisition of assets above a certain value, employment and dismissal of employees, distribution of dividend, etc. All this indicates that court does not control party. So such terms of the agreement indicate the existence of a joint arrangement, and often joint arrangement we are looking at 50% interest, and that seems to be the case. So in accordance with IFRS 11 joint arrangement, that is a joint venture as decisions are made at the entity level operations and not regarding individual assets. So joint venture, it means we use IAS 28 to account for it. Court argued that the restrictions do not constitute a hindrance to the power over to control, as it is customary within the industry to require shareholder consensus. However, the agreement contains so many significant restrictions with respect to operating a financial decision that does not entail control of party. And a shareholder consensus is required in respect of these significant decisions. And by that, it means that court might not be able to exercise its power. What is your conclusion? Our conclusion is that court should de-recognize or deconsolidate Parton as a subsidiary from his group because he has not got the control or he has not got the power over Parton, and instead should account Parton as according to IAS 28. So this is how you would have to conclude on the answer. I hope this helps to explain the principle of control to you. Let's take another one. Discuss using the IFRS 10 definition of control whether Edwards controls Hobbs. Whether Edward controls Hope. Let's see. Edwards, a public limited company, acquires 40% of the voting rights of Hope. The remaining investors each hold 5% of the voting rights of Hope. A shareholder agreement grants Edwards the right to appoint, remove, and set the remuneration of management responsible for key business decisions of Hope. To change this agreement, two-thirds majority vote of the shareholders is required. So if you look at it, two-thirds, and you want to look at what is the percentage of Edwards. Edwards has 40%. That is more than 1/3 of the voting right. So in terms of 100, if you say 100% divided by 3, 100% divided by 3, look at it, 100% divided by 3, that is 33. 33%, and that's 1/3 of 100. And Edward alone had 40%, and 40% is more than 1/3. It means that the remaining other investors collectively will be unable to hold 2/3 of the majority vote, unless of course they take part of Edward's interest. So our structure will be to use the definition of control to guide. So we look at the power to govern, exposure, and ability to use the power to structure the answer. So let's see. So first, the power over the investee to direct the relevant activities. So the absolute size of Edward's shareholding, which is 40%, yes, that in itself does not indicate control. So the absolute size of Edward's shareholding in Hope and the relative size of the other shareholdings alone are not conclusive in determining whether Edward has right sufficient to give them power. However, the shareholder agreement which grants Edward the right to appoint, remove, and set the remuneration of management personnel indicates that he has some power. So Hope gives Edward power to direct the relevant activities. This is supported by the fact that 2/3 majority is required to change the shareholder agreement, and as Edwards owns more than 1/3 of the voting right, the other shareholders will be unable to change the agreement, whilst Edwards still owns the 40%, and that is true. And the next one to look at is the exposure or the right to variable returns. As Edwards owns 40% shareholding in Hope, will be entitled to receive a dividend. The amount of this dividend will vary according to the performance of Hope and also dividend policy of Hope. Therefore, Edwards has exposure to variable returns. Then the last part of it is the ability to use the power. Now, the fact that Edward might not exercise the right to appoint, remove, or set the remuneration of Hope's management should not be considered when determining whether Edward has power over Hope. It is just the ability. He should have the ability, and Edward does have that ability, or do have that ability. What's our conclusion? Edward controls Hope, therefore Edward should consolidate Hope, or Edward is a parent of Hope, who is a subsidiary. So the IFRS definition of control has been met. It has been met. Edward controls Hope, and therefore Edward should consolidate Hope as a subsidiary in his group financial statement. So another very good illustration of the principle of control. I hope this helps you in your understanding. Let's move on to look at exemptions to consolidate. This is not new. Where we are looking at under what circumstances can the parent entity be allowed not to consolidate, even when they should consolidate. One, when the parent itself is a wholly owned subsidiary. So entity A is also a subsidiary of, say, another entity, maybe entity C, and therefore because entity A parent is 100% having 100% ownership in A, entity A can be allowed not to consolidate because the parent entity will consolidate both entity A and B. Or if entity A is not a listed company, entity A can be exempted from consolidation. Or when the entity own parents produces consolidated account. In this case, there is no need to have 100% ownership. So if the own parent produces consolidated account, then entity A can be allowed or can be exempted from consolidate because its own parent will consolidate both A and B. And then where the parent is a partially owned subsidiary and the other owners allow it not to prepare consolidated account. In that case, there is no need for consolidation. So these are very straightforward for you to look at. Now let's go to IFRS 3, business combination. What is the principle of acquisition method? What is a business? The IFRS 3 business combination, and you see the focus is that there should be a business acquisition before we can apply the principles of IFRS 3. That is why it's called business combination. There should be a business acquisition. And by this, the IFRS 3 define what a business is. Now it says that a business combination is where an acquirer obtains control of a business. What then is the business? The IFRS 3 defines a business as an integrated set of activities and assets that is capable of being conducted and managed to produce a return in the form of dividends, lower costs, or other economic benefit such as profits. What it means is that a business should be identified with activities. A business should be identified with activities, set of integrated activities. Now, these activities can be identified as a process of inputs which are converted into outputs. So a business has inputs. Not too clear, so this can be converted into outputs. So a business have identifiable inputs process where these inputs are converted into outputs. It does not necessarily have to be goods. It can be services. There should be a process of rendering a service and there should be an identified output. That's a business. And in this business, we have assets, and these assets can be used to what? Achieve the desired outputs. And the business would often have employees. The business would often incur costs. The business will often generate income, and the business will produce returns in the form of profits, dividends, or lower costs, which you can call cost savings. That's a business. So if there is any acquisition, we have to trace the details of the transaction to see if the supposed investee is a business before we can apply the IFRS 3. If you cannot trace that there is an integrated set of activities which are inputs and outputs, assets are used by employees to what? Carry out returns or generate income, incur cost, then such a transaction is not a business combination, and instead it should be an acquisition of assets. So the guidance is that if the assets acquired are not a business, the transaction should be accounted for as such. That is to say, it is an acquisition of assets. So you can use any of the standard or non-current assets to account for this acquisition, and we know you use the IFRS 3 business combination. Now, if the assets acquired do constitute a business, then we use the IFRS 3 using what we call the acquisition method. Now, what is that acquisition method? There are 4 steps to this acquisition method. The step 1 is to identify the acquirer. The acquirer is often the entity that, or the entity who obtains control. So the entity that obtains control is often the acquirer, or the entity paying consideration. So the entity paying consideration would often be the acquirer. So the buyer. Now, if we know the acquirer, the step 2 is to determine the acquisition date. The acquisition date is the date control has been achieved, and it's from that date that we begin to consolidate, and that must be clearly established. Now, the reason we need to determine the acquisition date is that there could be earlier investments. Maybe the entity had 30% investment before, and they have gone on to acquire extra 30%. The initial date they acquired the 30%, they have no control, but the extra 30% they have acquired collectively gives them 60%, and on the date they achieve this 60% is the date of acquisition, and the IFRS 3 says that we need to establish that, and from that date consolidation will start, and on that date we have to ascertain the fair value of assets and liabilities, and we have to measure goodwill. So the next step is to recognize and measure the identifiable net assets, and we see net assets, the identifiable assets, and then also the liabilities. So here the net assets will be the total assets less total liabilities, net. And the principle says that we should determine the fair value. So the fair value of net assets, so it means that if the subsidiary had some internally generated asset which were previously not recognized at acquisition, we have to determine the fair value of these internally generated intangibles. Once we can measure their fair value, they should be part of the asset value. Unless, of course, we cannot measure their value, then they go into the total value of goodwill. The same way, where there are contingent liabilities in the books of the subsidiary, which are disclosures, it is just disclosure requirement. IFRS 3 is saying that on the date of acquisition, such contingent liabilities should be recognized as liabilities, and these liabilities will reduce the net assets. Please, very important principle. Now, the last part is that we have to recognize goodwill. And as we are aware, goodwill is the difference between the consideration plus non-controlling interest, if any, NCI, less net asset, the fair value of net asset, and this will be equal to goodwill. So where we have the consideration and non-controlling interest, that represents the market value of the subsidiary, and if we less the identifiable net assets, the excess over and above the identifiable net asset, that is goodwill. And the goodwill is recognized as an acquisition or consolidation adjustment. It's a consolidation adjustment, which increases the total value of the subsidiary when we are consolidating. And the goodwill is not recognized in the books of the subsidiary, it's not recognized in the books of the parent. It is recognized in the consolidated accounts. Now, if the identifiable net assets are more than the value of the consideration and the non-controlling interest, then we say we have a negative goodwill. And as you are aware, negative goodwill is not recognized as an asset. Instead, we say there is bargain. There is a bargain purchase, and that bargain purchase is recognized as a profit in the consolidated P&L. So it is a gain on acquisition. However, the IFRS 3 says that anytime there is a negative goodwill, the investor should reperform the fair valuation of assets. Maybe the assets were overvalued or overstated. They should reperform the fair valuation of the assets. They should reperform the fair valuation of liabilities at acquisition. Again, the investor should reperform the valuation of the consideration. Maybe the consideration was undervalued or they were not at fair value. Then also they should recalculate the non-controlling interest. Now, after doing all these remeasurements and there is still negative goodwill, then the conclusion is that there is a bargain purchase, and that bargain purchase will be recognized as a gain on consolidation. It is immediately recognized as a gain on consolidation. Now, the last principle I want to indicate here is that on the date of acquisition, where the fair values cannot easily be measured, IFRS 3 business acquisition method allows 12 months from the date of acquisition for the investor to conclude on the fair valuation of assets. I take that again. The IFRS 3 says that if on the date of acquisition it is difficult for the investor to determine the fair value of the investee, who is a subsidiary, then there is what we call a 12-month period from the date of acquisition for the investor to conclude on all fair valuation. So it means that initially, on the date of acquisition, we will have what we call provisional goodwill, subject to final fair valuation. So the goodwill can change subsequently, but the investor have only 12 months to conclude on this fair valuation. So we can call it the fair value assessment period. The fair value assessment period will be 12 months. Great. Let's move on. For associate relationship, we say that the investor has significant influence. Significant influence. And what does significant influence mean? Significant influence means that the investor has the power to participate. The power to participate in the financial and operating policies of the investee, but it's not control or joint control over those policies. Now, the power to participate means that the investor will have a representation. The investor will have a representation on the board of the investee. So if we have 10 directors, the investor would have 2. And by the virtue of having 2 directors, the investor will be able to participate. The investor will be involved in the decision making, financial and operational decisions. But it is not having majority. And because it's not having majority, it cannot control. So it would only participate. And that we call significant influence. And that indicates an associate position. Now, the IAS 28 also gives absolute values which would be used to determine control. We'll look at that shortly. And by the virtue of the significant influence, the investor will have representation on the board, be able to participate, could have transactions between itself and the investee, could have provision of management services to the investee, or other technical services. Now, for the absolute values, the IAS 28 says that investments of 20% or more, but less than 50%. So investment of 20% or more, but less than 50% indicates significant influence in terms of absolute value. So if you have 21, 22, 25, 30, 40, 45, 47, 48, all of these, 49, all of these are significant influence. If it is 50%, that's joint control. It's not significant influence. Now, anything less than 20%, it means that we would have to account for it as a normal investment. As a normal investment under the financial instrument standards. And by the associate, we mean we have to do equity accounting. Equity accounting. And the equity accounting is to show the investment in associate. And the investment in associate, so the equity accounting or the equity method under the IAS 28 is to show the investment in associate, and the investment in associate is shown as a non-current asset, and it is the cost of investment plus or minus share of post acquisition profit or losses. And if there is any impairment in the associate, impairment loss, we less it. So just a simplified way of looking at the investment in associate, but this illustrates the point. Now, the share of post-acquisition profit is the same as the difference between the total net assets at reporting less net assets at acquisition. So what we say is that the equity method looks at the investment in associate, which is the cost of investment, plus the changes in the post-acquisition net assets. The changes in the post-acquisition net assets. So the net asset of the associate at the reporting date less the net asset at acquisition date. That gives us the value. So it is not often looking at only the profit. We can look at the OCI. So we are looking at the changes in net asset, the reserves. So while we have OCI items, they are also recognized as part of the value of the investment in associate. Great. We're going to build on starting with the consolidated financial position. What is the structure? What is the pro forma? And what are the working schedules required? Then we'll move on to the P&L, the consolidated P&L. Then we'll look at cash flow. Then we'll look at foreign subsidiary. So there's a long way to go to conclude on the consolidated financial statements. We start with the group structure. So let's look at the types of group structure. The first one is the normal group structure. So we have entity A having investment in entity C, B, and D. So the first point is entity A has 70%. So entity A has 70% in C. So 70% in C. Again, entity A has 90% in B. And then finally 60% in D. All of these controlling interests indicates that entity A controls these three, and all these entities are subsidiaries of A. Therefore, entity A, in preparing its financial statement, which is the group financial statement, should consolidate C, B, and D. Now, in each of these investments, for example, where we have entity A having 70% in C, the non-controlling interest will be 30%. So we can have a total of 100%. Where it has 90% in B, the NCI is 10%. Again, so we can have 100%. Where it had 60% in D, NCI is 40, so we can have 100% interest. So this is a normal group structure where we have entity A having more than one subsidiary, and at this level in the exam we'll be given more than one subsidiary, so we can have 2 or 3 subsidiaries, and we should learn how to consolidate these subsidiaries into the group account. The second type of group structure is what we call the complex group structures. Complex group structures. For complex group structures is where we have a subsidiary also having a subsidiary. So we say sub-subsidiaries. There is sub-subsidiaries. So the first complex group structure is what we call the vertical group structure. Vertical group structure. Now for the vertical group structure, here entity A has 90% control in B. That tells you there is 10% control for NCI, who are the minority. Now entity B has 70% in C. So look at it, it's vertical. This is a vertical structure. Our conclusion is that entity A controls B and entity B also controls C. This is through direct control. B also directly controls C. However, because A controls B and B controls C, A indirectly controls C. So we say through indirect investment. Indirect investment. So there is effective control of A over C. So A controls C through indirect investment or indirect control. And that means that entity C is a subsidiary of A. Entity C is a subsidiary of A, and therefore entity A should consolidate both B and C. The next example of compressed group structure is what we call the D-shaped, what looks like a D-shaped group structures, where we have to look at effective control or effective interest. Now I need you to pay attention here. Entity A has 60% investment in B, and entity A again has 25% investment in C. Now, because B have investment of 30 in what? C. If you put the absolute values together, 30% plus 25%, it means that both of them will have control over C. But we need effective control. So what we say is that, is entity C a subsidiary of A? The answer is yes. How? Because entity A itself have investment of 25%, then entity B has what? 30%. The two together indicate control. So therefore, entity C is a subsidiary of A. But what is the actual effective interest of A in C? We have to take the entity A's own interest, which is 25%. Please pay attention. Then we measure what we call effective interest. And the effective interest is the 60% of entity A's interest in B times entity B's interest in C. So 60% times 30%, that gives us 18%. And even though there is control and we are going to be consolidating, the share of post-acquisition reserves, etc., are not going to be shared using the 55%. We are going to be sharing all those post-acquisition reserves using the effective interest. So in this case, you realize that the NCI effectively has 57%, which is more than the effective interest of 43%. So look at it carefully. Entity A, entity B, entity C, the D shape. Entity A has investment in B, B has investment in C, but B's investment does not indicate control. We need to add that of A before we can establish control. Now, another example of the D shape, look at it. We have entity A having 70% in B. B has 80% in C. A itself had only 10% in C. But on the face of it, our conclusion is that there is control over C just by looking at B's investment in C. But we need to find the effective interest. So again, the question, is C a subsidiary? Yes. How? A had 10% that should be in C, 10% in C, and B had 80% in C. Collectively, we have 90%. But what is the effective, which we need to always calculate? The effective interest is that A's own interest in C, which is 10%, plus the effective interest of A and B together. So A's 70% times B's 80% will give us the effective or what we call the indirect interest. So the indirect interest will be 56, which is 70% times 80%. So the total will give us 66%, and the NCI is 44%. So is the effective interest 44% that we'll be using to calculate the goodwill on acquisition? In C, is the effective interest that we'll be using to calculate the post-acquisition sharing of what? Profit and OCI items. Very important. Now, in all of these, going back to the first vertical group structure, there is a very important concept which I'll highlight later, but I need to establish that here. You know, we have A having 90% in B, so the NCI in B is 10%. B is having 70% in C. It means the NCI in C is 30%. Now, because the NCIs in B also have an investment in C, we say that we have indirect holding adjustment. Indirect holding adjustment for NCI in B's who also owns some investment in C. And please, this is a very important principle at this early stage I want you to pick. And the indirect holding adjustment, we short it as IHA. And it's a very important concept that you should not miss. And we're saying that the indirect holding adjustment is to take out how much the NCI in B also owns in C. So what we would often do is to look at how much consideration. So the consideration B paid for C. Now, if for example the consideration B paid for C is, let's say, 10 million, then the indirect holding adjustment, would be 10 million times the NCI percentage, and the NCI percentage there is 10%. So the NCI owns that much of the investment in C. So the NCI indirectly owns 1 million of the investment in C, and that is an adjustment that we need to calculate. And this adjustment, we use it for calculating goodwill. So the adjustment, the indirect holding adjustment, is deducted from total consideration in C in calculating goodwill. And the same amount will be deducted from the NCI in B when we are consolidating. So we'll revisit this adjustment, but I needed to mention this at this initial stage because we are looking at the group structure. So the indirect holding adjustment is the portion of the investment NCI owns in C by virtue of the investment in B, and this is always excluded. It is excluded from the consolidation process. So when we are calculating goodwill in C, we take it out from the calculation. When we are calculating NCI in B, we take it out. Very important principle I want you to note. Now let's move on to look at an illustration. So this illustration, we'll take it from November 2018 question 1. So November 2018 question 1, note I and II. So I'll quickly show the question, then we read to analyze how we will establish the group structure in that question. So let me just zoom in a bit. Okay, quickly, let's go to the note. Let's go to the note 1. So this is the question. We are not reading the details of the question. We're going to note 1. So this is the note 1. We want to look at the group structure. Now it says that on the 1st of April 2016, Accra Limited acquired 14% of the equity interest of Takrady for a cash consideration of 130 million. So take note. Now on the face of this, we have Accra, who is likely the parent, Boko is subsidiary, Takrady is subsidiary. But in the initial stage, we seen that Accra owned 14% of Takrady. And if you see the year end is 31st March 2018. So if the acquisition of 14% at that date was 16, so we have 17, 18, so 2 years since. Now, and Boko acquired 70% of the equity interest of Takrady for cash consideration of this. So on that same date, here, that is control over T. At 1st April, the identifiable net asset value, that's not relevant. The retained earnings, we don't consider that now. At 1st April 2017, the identifiable net assets, retained earnings, etc. The excess, we'll look at it. The fair value of the interest, 14% holding, which was classified as this, that's fine. We'll look at that subsequently. Then on the 1st of April, Accra Limited acquired 60% of the equity interest of Boko. That is control. So this group structure, let's see how the group structure will be quickly. Let's draw that here, and would look at that as workings 1. So let's say group structure. We have Accra Limited, we have Boko, and we have Takrady. Now this looks like a D shape. So I want to establish the dates here. 1st April 2016. The investment was 14%. So let me indicate that here instead. So 1st April 2016. Then Boko had 70% on the 1st of April 2016, which is 2 years ago. Then subsequently on the 1st of April 2017, Accra Limited acquired 60%. Straight away it tells you NCI here is 40%. And on the face of it here, we need to establish the effective interest. So let's see. The Takrady is a subsidiary of Accra Limited because Boko initially had 70% of interest. So let's see how we determine the effective interest. Now, the effective interest in Takrady would be Accra, or let me say A is 14%. Okay, A's interest, let me qualify it a bit more. A's direct interest. A's direct interest is 14%. Then A indirect interest. And the indirect interest would be the 60% it had in B times B 70% in T. So times 70%. So let's establish that quickly. So we have 60 times 70, that is 42%. 42%. Because divided by 100 will give us 42%. So effectively 14 plus 42, that is 56. So we have 56% effective interest. So this is the effective interest. And then we have non-controlling interest will be 44%. So we have 100%. This is how we establish the group structure. Very, very important. And once you're able to do this, it sets the whole calculations for you up. And these are figures you need. So for the 44%, when we are calculating goodwill in Takrady, that is the percentage you need. And then the same values will be used for NCI calculation subsequently. But you have to also notice that because Boko had investment in Takrady, the NCI in B will have to lay claim to their indirect holding adjustment. And that indirect holding adjustment will be the consideration. So ahead of time, let me just show you that from the question. B acquired 70% for 635, and because 635 is the amount times 40% interest that the NCI had in Boko. So the amount Boko invested in Takrady, which is 635, NCI will lay claim of indirect holding adjustment. So when we are calculating goodwill, we take that value out, and the indirect holding adjustment will be 254 million. So very important, and this have to be excluded. So when we are calculating the goodwill in Takrady, we take it out. When we are calculating the non-controlling interest in Boko, we take it out. Very important. Great. So very good to lay these initial basis, how we deal with a real question, how we draw up the group structure, and how we find the effective interest. And like I said, the NCI will lay claim to indirect holding adjustment in Takrady. Very, very, very key in calculating goodwill and the NCI.